it's 9 p.m. This is the most definitive debate on development issues on Indian television. You're with the India Development Debate on ET. Now I'm Sandeep Gurumurthy. Joining me in Delhi is my colleague Supriya Srinath with a big story now. We told you first, and it's official now. The government will borrow up to 93,000 crore rupees from the market in the January to March quarter. A huge markup from what it had originally planned. Just to remind you, ET now reported earlier today the government's move to step up market borrowing plan for the last quarter. The move comes just a day after the centre reported a big fall in GST collections for the month of November. The additional market borrowing of about 50,000 crore rupees, which is way above street expectations, is sure to put pressure on the fisc because of several reasons.
Indeed. Now, the immediate impact, of course, will be on the fiscal deficit, which is sure to miss the 3.2% target for the current year. Also, bond yields could spiral, putting pressure on the overall interest rates in the system. And all this is coming at a time when an unexpected increase in rural allocation in the forthcoming budget is likely to push up inflation, which is already on the rise. On the India Development Debate tonight, we discuss the government's move to step up borrowing and what it could do to the economy at large. We are joined by a stellar panel right here. Govt Bhattacharya, economist, Axis Bank; R. Gandhi, former Deputy Governor, RBI; Dr. S.K. Ghosh, Group Chief Economic Advisor, SBI; and Maithili Basnoor, our consulting editor. So thanks each one of you for joining us right here on the show this evening. And I will begin things with you, Shogato. The Niti Aayog Vice Chairman was with us after this news broke, and he believes that additional borrowing to the tune of 50,000 crore rupees is a counter-cyclical move. I'm still wondering, A, do you agree with that hypothesis, and B, do you believe the markets are going to be impressed with that argument?
So difficult questions, and being the first to field. I'm a little ambivalent about the need for further increases, but he is very clear, the Vice Chairman of Niti Aayog, that the entire slippage, the higher borrowings, the fisc or whatever, has to come in from the capital side. There will be no slippage whatsoever on the revenue deficit side. So he is very clear on that. That whatever additional spending the government does or should do will be entirely capital expenditure. This is the same thing as borrowing money to buy an ice cream, and as opposed to borrowing money to buy an ice cream and borrowing money to buy a bicycle. His own analogy. So to that extent, I'm partially ambivalent to that. I'm not completely opposed to this. I don't want to comment on the market's view on this, because the markets are probably will just look at the borrowing numbers, not look at the potential additional spends, the effects of the spends, the marginal efficiency of investments, etc., moving in from the private investment to the government investment. On that question, let me just stop there.
Right. Maithili, come in on that. Is the market going to view this as a counter-cyclical move, 50,000 crore additional borrowing? Surely this is way more than what the market had priced in, or rather one could argue what the market was made to believe will happen in this financial year.
Sandeep, if you read the government's press release a little carefully, you will see that the government is going to borrow 50,000 crores more by way of market borrowing, but simultaneously it will run down its borrowing by way of treasury bills. So prima facie, the press release seems to suggest that the government is only doing an adjustment. It is running down the holding of treasury bills substantially and instead issuing dated securities. So the impact as of now, if we believe the government statement and take it at face value, would seem to be that the yields will definitely go up. And we will see yields which have already moved up by close to 80 basis points since July of last year. They're likely to go up even further. So the implications would be in terms of monetary policy. If the government runs down its treasury bills and then issues dated securities, it will not impact the fiscal deficit. But if it is not able to run down its holding of treasury bills and simultaneously issues dated securities, yes, then in that case, there would be a grave danger of government breaching its fiscal deficit. Because remember, treasury bills are always issued to bridge the leads and lags between government expenditure and revenue. So since GST revenue has been coming down, clearly the government does not anticipate revenues to look up, and hence treasury bills will no longer suffice. It needs to have a more stable source of funding, a longer duration form of funding, which is why it is switching now from treasury bills to dated securities. So as of now, let me repeat, no impact on fiscal deficit, yields will go up. But if it does not succeed in making the switch, then certainly fiscal deficit will go up.
But I guess that's what markets are worried about, that there will be a rollover impact of these treasury bills, even though they may not be an immediate impact. But I'm going to take this to Mr. Gandhi. And Mr. Gandhi, do you believe the impact will be muted, like Maithili is suggesting there, that if, the government is not able to do that in the immediate to the short term, right now only yields will go up, no impact on fiscal deficit. What in your assessment is the impact? Is it going to be muted? Because eventually there will be a rollover even of the treasury bills. And that's where the markets seem to be uncomfortable.
I don't think the impact will be neutral. In any case, market has been expecting some fiscal slippage. That's why you saw, you have been seeing that the treasury yields have been rising for the past 5-6 months. So, by market's suspicions have come true that government has slipped on the fiscal deficit, in the sense that additional 50,000 crores are being raised to be spending. Whether the rundown on treasury bills, as Maithili says, I am not able to understand that clearly, because treasury bill in the calculation of fiscal deficit, treasury bill position is not taken into account at all, because that is considered as a short-term borrowing. So it never influences the number fiscal deficit. So market borrowing, when it goes up, automatically it impacts the fiscal deficit number, unless you change the base. Instead of the start of the year GDP, if you calculate based on end of the year GDP, on that this additional borrowing, then the ratio may remain 3.2, but that needs to be seen. But the running down of the treasury bills, that inference which Maithili is taking, I am not able to agree with that, because I am not able to understand that properly. But the market impact will be, obviously, because immediately market will react, because it is additional borrowing. So to that extent, the yield may firm up a bit, but that is one way of looking at it. Other way of looking at it is the market has already seen it. It is only getting confirmed about it.
Shogoto, comment on that. How do you see the markets reading this? As Mr. Gandhi pointed out, obviously it will have a bearing, he says, on the fiscal deficit. The higher borrowing, market borrowing will translate into an impact on fiscal deficit. How's the street going to read it? We've seen today, we saw a knee-jerk reaction on the equity markets after ET now broke that story. The official announcement, of course, came in after markets closed for the day. What's your own sense? Will the market spare the government, or do you see yields rise significantly from here on?
Sorry, was that for me?
That's right.
Sorry. So, I'll duck this question somewhat. I don't think there will be a very major impact on the markets. I agree with Mr. Gandhi that there will be an impact, because some part of this has already been priced in. But the more important issue, other than the markets, there will be an impact. How soon it dies down is the question. The other impact is, as Maithili also pointed out, that this in itself is not indicative of a slippage in the fiscal deficit. Remember that together with the market borrowings and the T-bills, there is also the small savings. So now, if the small savings remain the same, what we were normally thinking, and small savings collections in the first 7 months have been very high this time. So if that trend continues, then that, together with the higher fiscal deficit, would invariably mean, because these are sources of borrowing, invariably mean a slippage in the fiscal deficit. However, if the small savings collection, due to some reason, the government expects that the small savings will not come in to the full extent of the amount that has been budgeted, and that is what is being offset by the higher market borrowings, that would indicate that the fiscal deficit would still remain at 3.2%. So that depends. We don't know the numbers for the latest numbers for the small savings. So to that extent. However, again, let me stop at that for the time being, but that's the analysis of the fiscal deficit, how the fiscal deficit will look, and consequently, and that will have some impact on what the market believes is the true story on the borrowings.
Actually, it's interesting that you say that, because the government has already trimmed the rate on both NSS and PPF by about 0.2% as we speak right now. So, the interest rates on small savings is indeed going down. But SK Ghosh, let me bring this to you. And, we've already spoken about the impact on fiscal deficit with most of our panelists right here. But is it a given now the 3.2% deficit will be breached this year? It's not going to be likely that we will meet this deficit?
No, it's already breached, Supriya, because the markets, if the only this borrowing impact is taking is adding 20 basis point to the headline fiscal deficit number. And if I look into the revenue slippages, the oil giveaways by the government in terms of excise duty cuts, that is adding another 10 to 20 basis points. So the deficit is already going to 3.5%. So the markets are now aware of this fact. My only thing is that it will be negative for the markets in the short term. There could be some impact on the yields. The stock market could go down, but over a point of time, I think it will be positive, because the markets will now know that the government is oriented more towards spending and possibly a growth oriented budget in the next fiscal.
Maitri, comment on that. Shaumakanti believes that the market is already beginning to work with a 3.5% number. He's actually saying that the fiscal deficit has actually already been breached, given what we've seen so far on the revenue side as well. Do you tend to agree with that? Because that's, let's put this in perspective. This would be the first time in 4 years that the government will not meet its stated fiscal deficit target for a financial year.
But Sandeep, let's also remember that next budget would be the last budget before the next general election. And given the slim majority which the government got in the Gujarat elections, clearly it realizes that it does need to spend. And if you are going to spend, and if revenues are not going to pick up, there is only one way you can spend, is by breaching the fiscal deficit. And remember, we already have the FRBM committee report, which does give you some leeway of a 0.5 percentage point whenever you undertake deep structural reform. So the government has all the grounds really to breach that fiscal deficit. They've already got a rating upgrade. So there's nothing really holding them back. So I think the government is being a little pragmatic. Yes, it is quite likely that you will breach that 3.2%, but clearly they're willing to take that chance. And right now what they're trying to do is shift out of T-bills into dated securities. But possibly if that does not quite succeed and the yields go up, and finally the market does show that if there isn't enough appetite for both T-bills as well as dated securities, and you have to have high T-bills and dated securities go up, you could see a breach in fiscal deficit. But clearly the government is not worried so much now about fiscal deficit. And I would think that a 3.2 to 3.4% is very much on the cards.
You know, Mr. Gandhi, I will bring this to you, and while we can keep debating the fiscal deficit, the reality was that it was a foregone conclusion even before this year really began. I mean, if you were going to have lingering impact of demonetization, and if you were going to roll out GST, there was ground for slippage. So the question to you really is, wasn't there a foregone conclusion? Shouldn't the government have just put it up front that we will perhaps borrow more, we will perhaps not be able to stick to our deficit? And do you believe that GST and the lingering impact of demonetizations was ground enough for slippage? I mean, GST for one is definitely a structural reform in that sense.
It is not correct to equate market borrowing figures as the equivalent to the fiscal deficit number. Fiscal deficit number is arrived at by one major segment, of course, is the market borrowing, but other segments are also there. So we need to see, like the other panelists mentioned, how the other factors move. That we have to see down the line. But the fact that higher market borrowing has been resorted to that extent, market impact will be there. That is all right. To answer your point, whether the government should have foreseen this in the year beginning itself, that is hard to say, because the GST related decision was being debated in the year beginning when the budget was being formed earlier. So, but the final decision about GST implementation came midway in the year. So, and after GST's implementation also, the reduction in the rates which was considered in the recent weeks, that has also not been factored in, could not have been foreseen. So, this impact of these decisions could not have been foreseen well in the beginning of the year. So, that way to expect that government should have in the year beginning itself should have gone in for higher fiscal deficit, that is not tenable.
Fair point. Shaumakanti, Ghosh, slightly tricky question. Moody's upgrade came in this year. S&P has sort of put a stable outlook on India. It was largely on account of the government's fiscal consolidation track record. And to that sense, is the government in a bit of a catch-22 now? Is there going to be added pressure on the government to meet its targets, maybe through cutting down expenditure or looking at other out-of-the-box ideas to boost up revenues? Divestment could be one of them. Is there going to be more pressure on the government given what has happened over the last 3 months with rating agencies?
No, I agree with your point, because the Moody's upgrade was because of the fiscal consolidation path which the government is pursuing. So there will be pressure on the government, but I think the government may have actually could have put the fiscal deficit at higher level at the beginning of the year, because when you are in a year of GST you are going to an GST, there is bound to be challenges on the revenue front, and then if that was taken into account at the beginning of the year, then the deficit could have been pegged at a little higher level than the 3.2%, because 3.2%, I had also said, I think in September I had said it is going to be a challenge on the part of the government to attain to the 3.2% target.
Yeah, and many believe that, and many agree with you that in September only the government should have put a higher borrowing and a higher deficit figure there. But Shaukat, if I may come to you, what does higher borrowing really mean for the interest rate trajectory? I mean, I don't believe that there was enough room for monetary easing, but what does this really mean for the monetary policy per se?
Well, I mean, Mr. Gandhi sitting there, I mean, I'd be really loath to stick my neck out on this. But let me say that, I mean, obviously, I mean, slippages in market borrowings or the fiscal deficit indicates some kind of a fiscal stimulus. And the world over monetary policy authorities would typically be a little loath when there is a fiscal stimulus going on to take as accommodative a stance in monetary policy as they would otherwise have. So to that extent, I mean, as we have debated over here, I mean, we are still not sure, as Mr. Gandhi was pointing out, that whether this slippage in the market securities, dated securities borrowing program automatically would indicate a slippage in the fiscal deficit. We are still not very sure, but assuming it is, assuming that there is an element of fiscal stimulus, and if that fiscal stimulus comes in partially through revenue spending, partially through capital spending, etc., there are so many parameters over here. So I think the Monetary Policy Committee would definitely take this into account. It's informing its views. But overall, I mean, if I were there in that group, I'd certainly take a much longer look at the fiscal stimulus, at the consequences of the fiscal stimulus than I would otherwise.
Okay, Mr. Gandhi, I have to ask you this then, given that you're the expert in the panel when it comes to the central bank, really, do you think this sort of shuts the door on a rate cut? And if anything, now a rate hike is possibly going to be in the table when the MPC meets the next couple of times?
If you go through the minutes of the MPC meetings in the last 3-4 meetings, it had foreseen that inflation will be trending up throughout the year. Even though market, everybody was looking at the interest rate at that particular moment, but MPC had seen it that inflation will be trending up throughout the year till the end of the year. That is on the inflation side. And on the GFT related, last statement, the MPC has clearly noted that there is likely to be fiscal slippage. So it has already factored in that there could be a possibility of fiscal slippage, and based on that only it had taken a pause stance last time. I would think that it will be a long pause rather than rate hike so quickly, because whether rate hike is likely to be there, that we have to see how the inflation projections will come for the next fiscal. That we have to wait for the Reserve Bank's projection and MPC's acceptance thereof in the February MPC meeting. So until that time, I would think that it will be a long pause. There is no, right now, there is no indication that there is likely to be a rate cut. That is unlikely.
All right, no indication of a rate cut and likely to be a long pause as far as Main Street is concerned, and you're really hearing it from Mr. Gandhi, who would perhaps know it best amongst all. But Mr. Ghosh, very quickly before I hand it over to Sandeep to wrap this up, does it also put more onus, I mean higher borrowing and as a result higher deficit, does it also put more onus on the government to rev up and shore up more disinvestment revenue, higher disinvestment target?
Yes, see, disinvestment target in my sense could actually add a cover of 20,000 crore extra, 25,000 crore extra to the 75,000 crore number. So even, but the problem is that there is revenue slippage is going to be a little bit on the significantly on the higher side. So that even if the disinvestment receipts goes up, and given the pressures on the government in a year when the elections are around the corner next year, And the other thing is that if the government keeps the deficit say at 3.5% or even at 3.6% this year, next year it could keep it at 3.5%, a little bit higher than what was envisaged in the NK Singh committee report, but still lower than this year. So that means the government can say that we are on the path to fiscal consolidation, but at the same point of time it can spend in an year when elections are around the corner, and no government should try to give out this opportunity of spending in an election year, because growth is now the priority of the government, and also the fact that the agricultural sector may actually see a lot of incentives. So if I take all these factors into account, I believe that the higher fiscal deficit this year could also percolate down to a deficit number next year which could be close to this year or even at the same level of this year.
Okay, Maitri, let you have the last word. This is going to be a tough one. I mean, it always is a difficult choice, in the budget, but this one particularly so because it's the last full budget of the government, and you're faced with a situation where there's acute rural distress, where the private investment cycle is nowhere close to being picking up. So obviously the pressure is entirely on the government, like Shoma Kanti pointed out, to spend in an election year. So do you agree with this assessment, 3.6% for this year, and bring it down marginally next year to show that you are on the path to fiscal consolidation? Will markets digest that?
Well, quite possibly, and markets won't have much of an alternative, because if that is the number, they'll have to live with it. But clearly yields will go up. And what it clearly means is the RBI's any scope whatsoever for the RBI to cut is completely out. Even the pause which we're seeing right now, might subsequently be followed by a hike, because come February, we're going to see the government's budget. The 1st of February, we'll see the government's budget. The MPC meets after that. And if there is a fiscal deficit, then the MPC has every reason to say, see, remember we told you, so monetary policy must remain tight. And all over the world, including in the US, we're seeing Trump using fiscal policy. So I think with the elections coming up, with India becoming an inflation targeter, clearly fiscal deficit is likely to slip, and the government is quite happy to go along with it. Even if they say, officially they say no, that's what their position is going to be.
All right, we'll leave it at that, Maitri, there. Thanks for joining us. Completely timed out on this edition of the India Development Debate. Many thanks to this wonderful panel for taking time out and joining us with their perspective on this big story, big breaking story on ET now, where the government has increased its borrowing target for this year. It's come as a bit of a surprise to the market, and it obviously puts the spotlight on Finance Minister Jaitley ahead of the union budget. How is he going to balance the fisc? The imperative of spending in an election year vis-a-vis the imperative to be prudent with an eye on rating agencies. Remember, one of the things that this government has earned is a reputation for macroeconomic stability. Can he trade that off for growth in a difficult year? That's the choice he needs to make in exactly a month from now. Supriya.
Indeed, and Sandeep, I think the question also really shifts from unconventional monetary policy the world over to fiscal and counter-cyclical measures on the fiscal front now that the world is embracing, and India perhaps is no exception to that. But on that note, completely out of time on at least this edition of the debate. But coming up next is a fascinating debate that we bring to you as far as the winter session of Parliament is concerned. We've just about saved the session in the nick of time, but is it too late and too little to save so?